I think a big thing that Powell's really looking at is this tariffs boosting inflation. I saw a couple videos of some small businesses, got hit with the China tariffs, and they're just adding those tariffs. For example, a woman who sells high heels, she's adding anywhere from $60 to $100 extra, and she's labeling that as tariffs that she has to pay because of the manufacturing from China. We've seen multifamily really take a strong hit over the past couple years. It's still taking a hit. We anticipate that even roll into the end of 2026, beginning of 2027. When it comes to the multifamily sector, possibly 2028. So depending on what type of investments you are in, I think it's very important to understand where that investment currently sits, where's that debt product currently sits.
Welcome to the Chris Salerno Show, your go-to for real estate, business, health, and family insight. I'm Chris Salerno, CEO of QC Capital. Each episode, we explore the latest trends and expert advice from industry leaders. Whether you're an investor, entrepreneur, or seeking balance, this show provides an inspiration you need. Join us and elevate your game on the Chris Salerno Show.
Hello, welcome to the Chris Salerno Show. I'm your host, Chris Salerno. Excited for today's episode. We're going to talk about recent data and trends. Well, hey, Feds are meeting in September. A lot of people are saying they're going to cut about half a point, so 0.50 basis points. Are they? I think so. I think with the data that's showing inflation, the data that's showing unemployment, it's very difficult to get jobs right now. I think we're going to see that drop. And I got some wonderful shout out to the team for giving me some beautiful papers here. I'm going to rattle off some statistics on probably what the Feds are looking at and why they're going to make that decision of a half a point rate drop, which it needs to fuel the economy. I think a big thing, too, I noticed last year they miscounted the jobs by 911,000. That's a huge number. And obviously, Powell and the Feds were going off that number to keep rates so high. In my opinion, I think they kept rates too high for too long, and they're going to have to drop them even lower just to come to a stabilization of fueling the economy. But we shall see. We do anticipate it. But yeah, right now, with jobs, what we're seeing from August 2025, U.S. jobs added only 22,000 non-farming payroll jobs, a big slowdown. We're seeing a huge slowdown. Unemployment rate ticked up or actually held steady at 4.3%. Which is fairly high when it comes to it. Wages continue to grow, but very slow at 3.7 year over year on hourly earnings, but it's down 3.9 in July. Yep, that's from Reuters. So, with that, I think the Feds are going to make that ultimate decision on cutting those rates. They're definitely going to need to cut those rates. With unemployment claims and job openings, first-time jobless claims rose sharply at 263,000 in the week ending in September 6 of 2025. And that's by the AP News, highest in nearly 4 years. So right then, also job openings decline. In July of 2025, there were 7.2 million job openings. Also, the number of unemployed persons has in some measures started to exceed job openings. And I think you can see that right now. There are more people out there hunting for jobs, and there's not enough jobs for them to work. Now, are we going to say that's tariffs? Or are we going to say the economy? Are we going to say it's what he inherited? I think the big thing is that, again, rates have been high for too long. We need to decrease them. Other countries have decreased their rates. We need to decrease them to fuel the economy. I would say leave a comment in the comments. I would love to hear from you. What do you think they're going to do? It's going to be a point, half a point, quarter a point. I'm interested to hear. I think it's going to be a half a point. They're going to need to drop it faster than what they anticipated. So drop a comment down below. I'm interested to hear what your thoughts are on where those Fed rates on actually how much they are going to drop. So with that, I think that's going to fuel the economy. I think there's going to be twofold. So as interest rates drop, the single-family housing market, a lot of people will jump out into the single-family housing market and want to go buy a home. Well, when you have a bunch of people running to go buy single-family homes, that gives it, it sways the pendulum into the seller's market where the sellers can, start asking a little more. So does the price of single-family homes start to increase and real estate start to increase just because rates drop? Or will this interest rate really affect the 10-year Treasury? Last time they did a rate decrease, 10-year Treasury didn't really bump, didn't really move much. So, will that happen again? I think it's something to take a look at. I think what we really need to look at is the inflation, the jobs, the unemployment. And, I think what the issue is that we've just been getting data from last year and this year that is not accurate data. the data is coming in and they're like, oh, sorry, we missed something, and having to revise the number. So what type of data are the Feds actually really looking at to get a good understanding on where they need and how they need to drop these rates? But again, in my opinion, they need to drop them now. If they don't, it's going to be even worse if they wait. And I think they're going to have to drop them more than what they would like to get the economy in a fueling environment to fuel the economy and people start spending. I will say a lot of people stopped spending as well. They've watched what they've spent. We are at an all-time high with credit card debt amongst the U.S. citizens. So I think a lot of people are holding back. They're tapering back what they're spending. And, I think they're focusing just on their necessities. So if you're a grocery-anchored retail real estate investor, kudos to you because you did well during COVID. You're still doing well. That's a necessity. Everyone needs that. But I definitely think they're going to drop a half a point. They're definitely going to need to when it comes to it. What does that look for the financial markets? I think the financial markets are going to reflect those meeting notes, and I think they're going to reflect in a positive way. They did last time when Powell said that they were speaking about the rate cuts and that they are looking forward to the next meeting, and we saw a positive impact. I think you're going to see a positive impact in the stock market as well when they do cut those rates. The impact, I think, is going to be a ripple effect over the commercial real estate industry till probably about Q2 or Q1 about next year. Q1 to Q2, I think you'll start to see a big influx of that really happening. They're going to have a couple more, at least a point in total or a point and a quarter in total to really see a huge impact. But I think it's going to rebound in Q1, Q2, especially in the multifamily sector and commercial real estate sector as a whole. I think that's definitely something to watch. A lot of people are saying 25 basis points. I think it's going to be 25 to 50. I really think, based off what I'm seeing currently, and I just got an email this afternoon from one of our bankers, they're definitely anticipating a rate cut, but I definitely think it's either going to be a quarter or 50. I'm leaning a little more towards a 50. I think they're going to need to do that to fuel this economy, given the information that came out from last year being wrong and also the numbers that we're currently seeing. So the eyes will definitely be on the Feds, and I know Trump will definitely watch him extremely closely. I think the big thing is, for consumers, loans, mortgages, credit cards, that rate cut, is that going to affect it? Again, the United States citizens have a tremendous amount of credit card debt that they are piling up. With those rate cuts, it's definitely not going to impact that, but I think they're spending a lot more money. I think you're seeing people spend a lot more money, and it's going to be tough times. And the reason why is because there's not enough jobs out there. A very great person I love, CEO Jamie Dimon of Chase Bank and JP Morgan. He even said a couple days ago, I think I shared on my social media, that he doesn't know what's going to happen. And thankful, and that's what I respect about him and meeting him a couple times is he's just blunt and he's honest. He doesn't truly know what's going to happen. It's a very unique time, and it's hard to call right now. And that's being honest, and that's true. It's definitely very difficult. A lot of people are racking up a lot of debt. And also the rates have been high for way too long. So, I side with them, especially when it comes to the economy. Who knows what's going to happen when it comes to, one, the rates and how the economy is going to be impacted over the next 6 to 12 months, just given current debt environment on how many people are in debt and how high those interest rates are. So we'll see what happens here in the next couple weeks when the Feds meet. I believe they're supposed to be meeting tomorrow. Is that right? Tomorrow, what is it? The 17th? Yeah, they're supposed to actually be meeting tomorrow, the 17th. So we'll hear, this will probably roll out a little after the 17th, but we'll hear what they have to say. I'm curious what you guys have to say too. So don't forget to drop what your thoughts are in the comments in regards to what do you think the Feds are going to do. If this is late, then you already know, but I'm interested to hear what your thoughts were when it comes to it. New Fed governor confirmed. Stephen. All right. Stephen Myran, new governor confirmed, or new Fed governor confirmed just before the meeting. I think Trump's going to get some new people in there. I think he wants new people in there. Someone that, obviously is in his view of the economy to help boost and fuel the economy and obviously sway when he needs something for the economy. So I think some new blood in there is going to be great, especially. I know Powell has been in there for, I believe Trump's first administration. I know Biden's, and I think before Trump as well. So he's been in there quite a while. I think some new blood needs to get in there, especially throughout the whole Federal Reserve, to make sure everything is really focused on today's market and how to make today's market is perceiving when it comes to all the tariffs, inflation, job reports. It would be good to get some new people in there. I think it'd be a surprise if we had no rate cut. I definitely think it would be a surprise. I definitely know Trump would not be happy if there was no rate cut, and Powell will just get a lot more heat. The whole Feds will if there was no rate cut. So I definitely don't see that happening. I definitely see a more aggressive cut, about 50 basis points, just because a lot of information that came out that was not accurate for last year and some of this year. So I see an aggressive, but I wouldn't be shocked if the base case of 25 comes around because they want to slow it down. In my opinion, I think they're going to have to go a lot faster than what they want to get this economy fueled. It is a slowing in the market. We're seeing that, and I'm seeing that amongst multiple different type of industries, that people are just not wanting to spend what they used to spend, and also their money's not going as far as what it used to. So they need to change it. I mean, $14 for a carton of eggs at Whole Foods is getting a little ridiculous. I'll tell you that. I think a big thing that that Powell's really looking at is this tariffs boosting inflation. I saw a couple videos of some small businesses, got hit with the China tariffs, and they're just adding those tariffs. For example, a woman who sells high heels, she's adding anywhere from $60 to $100 extra, and she's labeling that as tariffs that she has to pay because of the manufacturing from China. So I'm interested, I think that's one thing Powell wanted to see is with the tariffs, is it coming back down to the consumer where they're having to pay more money for goods that they did not have to pay for prior to the tariffs? And, is that causing the hyperinflation of these products to where inflation is above that 2%? And we're not getting down. It's definitely going to be very interesting once these rates go down. I know the public markets will be fueled, but if we start to see the real estate economy be fueled, will that, and comment below because I want to hear these thoughts from you guys as well, will that widening the gap of rich and poor and really stretch that middle class? If we start to see a huge fuel in the economy with these rates to start to go down, will that start to widening that gap? I do think there is a gap widening between rich, middle class, and poor. I'm interested to hear your thoughts on with these rates dropping over the next couple of years. Does that fuel the economy, and do you think it's going to widening that gap? So we get a lot of questions about the economy, the environment, political things that have been going on. How does that affect investments, passive investors? For those LP investors that are out there, I think it's definitely crucial to understand what type of asset class you are in. We've seen multifamily really take a strong hit over the past couple years. It's still taking a hit. We anticipate that to even roll into the end of 2026, beginning of 2027. When it comes to the multifamily sector, possibly 2028. So depending on what type of investments you are in, I think it's very important to understand where that investment currently sits, where's that debt product currently sits with those investments. That is definitely crucial. You got to be extremely cautious on the type of debt product you currently have. If it's long-term, will it weather out this storm that we are currently seeing? And how long of a product do you have? I know for some of our assets, we're refinancing into HUD, long-term 10-year fixed debt. Reason being is because those are 10-year fixed debt. You can't play with it when it comes to the interest rate. And when the markets rebound within those 10 years, we'll be able to sell. And so when you are, as a passive investor, it's very, very important to look at your investments, your type of debt product that you have on those investments, and what type of consumer are you targeting to see if it's going to be a negative or a positive impact to your LP portfolio. That's extremely important. I highly recommend looking at that debt product and getting a good understanding of the options on if rates stay up a little longer, if rates do not, if rates start to decline. What does that look like? I will tell you, from the individuals I spoke with, no one predicted what we went through of high interest rate environments at such a quick pace. No one predicted. I've talked to individuals that went through '08, the dot-com crash, 1990, early 80s, and no one predicted what we all went through. And I think it's definitely hurting a lot especially if you're in the real estate industry, really any industry that you are accepting debt. And depending on that type of debt, when it has come due, given the current market environment, it's impacted you in some sort of way. So I think that is a big eye-opening and shocking experience that a lot of individuals and very well-experienced individuals have gone through. And it's very important to pivot, maneuver, and make sure you've set yourself up and your LP investors. And if you're an LP, your LP portfolio for success by knowing what type of debt, what type of real estate product. Is it strictly real estate? Is it a mixture of business and real estate like car washes? Is it a triple net lease? One thing we have with our flex industrial space, which is all triple net of small businesses, we vet those businesses. We look at their P&Ls. We understand how healthy those businesses are before we'll lease to them. We want to make sure that they can go ahead and pay the rent and that they are healthy. They have savings. They understand the P&L. They understand managing their business's capital. So I think that is super important depending on the type of asset class. If you're in multifamily, vetting those tenants very thoroughly, understanding what type of business are they a nurse? Are they a doctor? Are they an attorney? Do they just, work at a distribution plant? Understanding what type of business they are in and really making sure and getting comfortable that business will be around very strong, because you're seeing a lot of other companies lay off people, cut their expenses substantially because of the current market environment. So watch that extremely closely. I think great news is I think the marketing team wants me to do more of these one-offs, type of solo podcasts for everybody, giving updates on the market, maybe some of the political things that are going on. Who knows? We may touch on that here in the near future. I want to appreciate everyone who listens to the Chris Salerno Show. If you have not yet, please subscribe and rate us. That helps us get this show out to other individuals, help them gain knowledge. Also, if you have not yet, please follow me on Instagram and Facebook. I would love to hear from you. We post multiple times a day, so you'll be able to see motivational and also clips from multiple different podcasts. So please follow me on Instagram and Facebook. I appreciate everyone, and we'll see you later.
Thank you for tuning in to the Chris Salerno Show. We hope you enjoyed today's episode and gained valuable insight to help you along your journey. Don't forget to subscribe and leave us a review on your favorite podcast platform. If you have any questions or topics that you would like to cover, feel free to reach out directly to me. Shoot me a message on Instagram at Chris_Salerno_. Until next time, keep pushing forward and stay inspired.